This is business finance policy and strategy. As we have discussed earlier, I think we are on chapter 12 now. So that is management financial resources. As I've told you earlier, we have 3 resources, irrespective of the type of organizations that is in operations, whether small, big, or medium. So we have 3 resources. I said to you, we have financial resources, material resources, and human resources. So that human resources is otherwise called personnel resources or personnel management. So, but we are basically discussing on or concerning on the management of the financial resources, because financial resources are the things that the company needs to acquire the uses in order to acquire the other resources. So which the company use to further their product in order to have their own output for their final consumers. So the financial resources could be seen as the model of all the other resources in every organization, be it the physical, the human, and the information financial resources. It seems to be the basis of these acquisitions in any business. So when we are talking of this financial resources management or management of financial resources, we cannot rule out the budgeting as a form of financial resources. And when we are talking of the budgeting under it is the acquisition of resources is one of the most important aspects of a company's or business, because the trade-off between the type of the resources and their resultant event on one another. So this same importance holds for the management of the resources. So the best way to manage the resources is to have the budget for each of the units or department in an organization, so as to avoid wastages of either of those resources, either financial, materials, or human. So a budget it could be seen as a plan or a kind of outline of the control which a unit put in place to have a judicious use of their resources allocated to their unit or their department. So in an organization or the business, there are mainly 4 types of budget depending on the target of the business. So we have the manufacturing budget, we have the research and development budget, we have advertising budget, then capital equipment budget, then we also have sales budget. But when we are talking of the owner of the budget, of course, so the business managers or the ownership business, the owner of the business works within the confine of their budget, such that there will be no wastages or shortage of any resources. So a well-managed budget provides good result for any business firm or venture in terms of profit or sustainability of their business. So the task of any manager is to allocate and use all the resources under his or her own care or control to meet the purpose of the organization. So the successful management of all the resources depends on effective planning, strategy, and actions that is applied. So it is not the robustness of the budget, but the ability of the manager to make use of the limited resources at his own care, so as to achieve the target of the business effectively. Now we have consultations with what? Consultation with a subordinate and or delegate. Yes, if we really want to manage the resources very well, we may not be there, but the work might be going as expected. So that means the delegation of an authority can be used in order to judiciously make use of the resources available. So as a manager of the resources, whether physical, financial, or information, there is need for you to consult with those who work with you, so as to carefully analyze the needs in each area. So it is not uncommon for all the managers of the resources to probably fail because of their refuge to consult their subordinate. So there is no idea that is foolish or undergo, but a careful analysis of all the ideas could save and bring about the progress in the business. So therefore, there is need for consultations and sales of any ideas to subordinate. Who knows? Or the least staff of the organizations might save a collapse of situation of a particular business with or with his or her own idea. It's just like when we are talking of the security in an organization. People underrate security in every organization, whereas they are part of the most important unit in an organization. Because if anything is missing in an organization, they have to consult the security, because there is no other way or no other route that any staff could take any product out except through the gate. So if the security now find it very difficult, or the management have now find it very difficult to have met the security in order to verify or to make a verifications on how the product is taken out of that organization, there is no way they will find solution to that. So that shows how important these type of resources are. Then chapter 13, we have the bank credit. What is bank credit? Well, bank credit can be seen as the risk rating of bank, or a kind of internal credit rating. So credit is the way which bank makes their businesses. So it is this credit that keeps most of the banks in business. What are we talking about? When we are talking of the bank credit, that is giving of an advance or loan to the customer, to their potential customers. I call it potential customer because there are some customers that are not really qualified to be given a credit or an advance. Are we getting it? So it is from this, it is from this advance or credit given to the potential customers of the bank that the banks also makes their own takings or their own profit. So when bank receive deposit from the customer, they do not keep those money in their own vault, waiting for when the customers will come withdraw. No. But for the fact that there will never be a time that customer will coincidentally want to withdraw, at the same time, their deposit. So therefore, this leverage provide avenue for transactions window or the banks to give out loan to other we want. That is the other person that wants money. Okay, take for example, Mr. A deposited 500,000 naira, but Mr. B came over to take an advance of 250,000 naira. So the bank will, with player, give out that 250,000 naira from what exactly Mr. A have deposited. Are you getting it? So, for instance, now, when let me give a scenario. When another scenario rather, when a customer deposits say 1,000 naira in his or her own bank account, the bank might, let's say, give 10% interest payable on the deposit. So the bank use this money and give out as loan to an investor for say 15% interest chargeable. So based on the analogy, the bank is making a gain of 5% invariably. So on the 1,000 naira deposit of the customer. So in this transaction, the bank has credited a credit facilities and also credited money in the circulations without the central bank of country meeting money in circulations. So how bank create credit? Yes, the main activities of bank are creation of credit out of the deposit received from the customer. So now, if 10 people or 10 of their customer deposited so 1,000 naira or 100,000 naira or 1 million naira, look at it. 10% will be retained, 5% will be gained. So that is how bank create money. The creation of credit by the bank is as the same thing as making profit by them. Now, we are talking of the advance or loan. So the principal business of the commercial bank is to make loan to a qualified borrower. You can see, as I've said earlier, a potential and qualified customers to be given loan, they are the qualified borrower, or at least they make easier for their customers to what? To be given credit from their source, with a bank perhaps agree to underwrite a customer's security issues or a kind of guarantee a loan from a third party or lender. So meaning that is why some banks will ask you to give the statement of your cash flow analysis or statement. Or because in the olden days, most of these banks, they do rely on the collateral security, that is the certificate of ownership, either to the land or to the any other properties. But today, they believe there are so many people that are interested in taking loans from their institutions, but they find it very difficult to have this collateral security in one way or the other. So they would rather demand from them a kind of cash flow movement or statement. So that will now give them what exactly in their template as expected, their flows, their inflows, and their cash outflow. I think you understand that. Now, deposit. For bank to widen or to broaden their credit creations, so they draw on a wide variety of deposits and non-deposit source of kind. So it is not uncommon knowledge that the bulky of commercial banks fund, about 2/3, that is 2/3 of the total funds, is from deposit. So the deposit comprises of demands, savings, and time deposit. When we are talking of the time deposit, that is a fixed deposit. That one takes more than a year, from a year above. So because the bank, we totally agree that this person will not come back to demand for his money in the next 6, 7, 8, 12 months. So they will now be relieved of giving that money to their needy customer. So the bank deposit is commonly used with check, and they are used to transact on the account, while the savings are deposit, which is generally bear a relatively low interest rate, but it may be withdrawn by the depositors with no notice. You can see it. So compared to that of the fixed one, as I've said earlier. So we have non-deposit source of finance or fund. So one of the most significant trends in banking in recent years is greater use of non-deposit fund borrowing, especially as competitions, the deposit increases in the bank. The bank resort to purchasing of reserves, that is federal bonds, from other banks. So in the recent time, banks have turned to the new style of depending on the loan depositing source, which is including the floating rate commercial deposit, that is CDS, and notes sold on international market, sales of loan, securitizations of selected assets, and standby the credit guarantee. So these and so many ways the bank can create credit in the economy, which helps to expand the economic activities as it leads to growth. So what are the importance and implication of banks' credit creations? Yes, the capacity of the banks today to create and destroy money and to even deposit have various vital roles for the financial system and the economy. So the creation of money by banks is one of the most important sources of the credit fund in the global economy. So an important supplement to the supply of savings in providing funds for investment. So the economy can grow faster. So the money created by the bank made available. Are we getting it? So then the destruction of the deposit by banks credit. When you're talking of the destructions, where in as much as the bank expand the deposit, they create credit by a multiple amount, but they can also well contract deposit and money by the same multiple amount. So this transaction is illustrated as below. So when you look at that, you discover that when you look at this screen rather, you will see the level of the asset, then you see the level of the liabilities. So we have the deposit of 1,000 naira. There is a reserve of 200 naira. You can see there is also cash loan of 50 or 80 80,000 or whatever. So we have this. You can see it. So when you look at that, it is quite unfortunate that there's no opportunity for broad explanation. So just look at it. You will understand it better. Now, let us quickly go to what they call the types of bank credit. That is chapter 14. When we are talking of the types of bank credit, any banks that perform the functions of accepting deposit and advancing loan to or creating credit, that is part of the function that differentiates commercial banks from other financial institutions. So that is why they term them as a commercial bank. So this is a bank that opens all form of account to allow deposit. So for example, now it opens its current account and accepts check on them, savings. They allow joint account where they allow joint account where husband and wife can open an account, where two friends or more can open an account. So there is one corporate account. That is an account opened by or operating by the company and or a corporate entity. Then there is also minor account. When we are talking of the minor account, they are the accounts that are open for underage. When we talk of underage, that is the person that has not, the children that are not up to the age of 18. Then we have asset of valuable for safekeeping. That is keeping of what do you call keeping of valuable items in the bank. So they are, because they also charge for it. Are you getting it? So the loans and advance now, bank give loan and advance to their customers at all interest higher than the one they pay on deposit. So it is the difference between the interest charge on loan and advance. Even the interest paid on the deposit and time the bank make their profit. So when you look at that, you discover that advance loan to their customer, they open an account in the name of the borrower and they do not pay them cash, but they allow them to draw the money using the checks. So because as a result of drawing the check, they will also charge certain things, the certain amount of money. So when they grant the loan or an overdraft, the bank has credited the customer's account. So it is not uncommon for people to see loan or advance to mean the same thing. So loan is an amount which banks allow you to withdraw when you must have shown your interest or intention by applying for it. And it is also approved. So it is not necessary that you must have money in the account. So except even if it is an advance, sometimes we call one an overdraft. That is when you will be allowed to draw money more than the balance you have in your account. So you may be required to produce a security or collateral. So the loan could be for 1 year or more. But an overdraft, as I've said, is that which your bank allows you to withdraw more on your what? To withdraw more on your account above your balance, and could be either short period of time or 3 months, basically 3 months. In this sense, collateral is not needed as a security for such a loan. So that is that. Then equipment leasing. When we are talking of equipment leasing, this is a method of financing which the bank do on behalf of their customer. So in which equipment or other fixed asset will be bought by the bank for the customer who has little or the title rather to the equipment or asset without paying one couple. So that is what they call lessee. So which is the bank agree with the lessor. So which is the users of the equipment or the asset to be paying as an agreed sum of money. So for a determined period of time. Just let me give you a scenario. under this. Just like my parents or my father has a pieces of land at Ugando. Are you getting it? And there is no money to have possibly put a structure on the land. So I can easily meet my bank that, okay, this is a plot of land and I want like 5 or like 25 shops on it. So the bank will just try and meet their valuer. They will go to the land, they will value the land. So they will now also put up a particular structure that is expected to be put there or to be erected there. So having valued the amount, they will communicate it to the owner, to me. So we now have an agreement. Okay, if this building is structured or this shop is structured on the land, that means the bank will use it for so period of time for them to recoup back their money. Of course, during that period, I will also be giving certain percentage. Are you getting it? So that is the equipment leasing. So the total cost of the equipment by the bank will be added together with the interest. We form part of the contract term. Then we have interbank float. Or this one we sometimes call it call money. It's a short-term money market which allows a long financial institution, that is long-term financial institutions such as a bank, mutual fund, a corporations to borrow and loan money in interbank rate. So the loan in the core money market are very short, usually lasting no longer than a week, or often used to help bank meet their reserves requirement. So this form of loan will not be advisable to be used for or by the business or investment company. Their yield will take will take longer period, but this is because of the short nature of its maturity. So it can only be used by bank, as mentioned above, and to meet the immediate financial trap of the bank. The lenders of this fund rises or
Everyone, please be patient for your lecture. I guess he's having it.
In its maturity. So it could be sold off in the secondary market. Here, investors and institutions constantly trade the banks' assets. Then they are called commercial paper. Most corporations and business investors try as much to avoid borrowing short-term money banks because their desire to avoid the short-term credit and the bank led to the widespread popularity of the commercial paper. So the commercial paper is just an unsecured short-term loan issued by the corporations to the recipient at a discount reflecting current market interest rate. So it is usually mature within 1 to 2 months on the average. And this facility is good only for the first moving business, like petroleum dealers and other least moving business. So there is what they call a bill discounted or treasury bill as well. Yes, treasury bill, of course, they are all, it is also the term loan that mature between the 3 months and the 1 year. They are normally purchased for a price that is less than their face value, even when they mature. So the percentage of the bill when matured is just 2% of whatever amount you could have bought. That is, if you bought 90 days treasury bill, and hold on to it until maturity, the treasury bill or the discounted bill are the most popular money market instruments that are affordable to individual investors because they are issued in smaller denominations, and they are also considered as risk-free. So the only disadvantage this year is that because of the low risk, the return is not, but they are exceptionally considered. So before we move on, let me quickly give you another assignment. Let me quickly give you another assignment. Now, analyze the 10,000 naira, analyze the 10,000 naira to that as a question. So you let me know how much the bank has realized from the deposit of 10,000 naira by a customer A. That is one. Then number two, I want you to also discuss. I want you to also the I want you to also discuss the promissory note as the part of bank of credit creations. So that is